friends, I'm taking you through financial statement analysis, and the last that we did was a technique of analyzing financial statements, especially the profit and loss account and the balance sheet. We had covered comparative analysis in the previous lecture, and today I'm going to take you through common size analysis. Common size analysis does what comparative analysis fails at. That is, comparison of companies which are not of the same size. And how is that done? That is done by standardizing the income statement and the balance sheet. And it's a really very simple procedure. Let's see how that is done. Let's start with the common size analysis of the income statement. Now, this is the income statement of three different hypothetical companies, company A, B, and C. The top portion shows you what the generic income statement would look like. That is the numbers. And you can see that company A has sales of $10 million. So does company B. And company C has sales of $2 million. And let's assume that these three are peer companies. That is, they all are in the same industry. If I was to compare these companies just with these figures, I can compare company A and B. But I cannot compare these companies to company C because you can see that the sales volume of company C is very small as compared to company A and company B. So how do we standardize a company? How do we compare it using common size analysis? For standardizing the income statement, we usually take sales as the base figure. Considering sales to be 100%, we calculate the percentages of all the other components on the income statement with respect to sales. So you can see that the lower part of this slide shows the common size income statement for these three companies, and each of the item on the income statement is presented as a percentage of sales. So let's see how you can convert any company's statements into common size statements. Start with company A. If we take sales as 100%, then cost of sales at 3 million is 30% of 10 million. Therefore, cost of sales comes out to be 30%. Similarly, you calculate gross profit, selling general and administrative expenses, research and development costs, and advertising costs as percentage of sales. And finally, the amount that you will get is operating profit, again as a percentage of sales. On the same lines, you should make the common size statements for company B and company C. I usually take the figures in an Excel sheet and I insert a column after every column. So I usually insert a column here, one column here, and another column here. I put a formula in each of these cells and I just pull it down so that I can get the figures for common size analysis. So let's see how these can be analyzed now. Now you can see because these are just percentages, you can compare them easily, and you can see that both company A and company C have cost of sales as 30%, while company B has cost of sales of 75%. That means either its raw material is more expensive or it is using traditional technologies to manufacture its products. You can find out the reason for these differences if you go into more details in the annual reports of these companies. Similarly, we can see that company A and company C spend extensively on research and development, while company B does not spend any money on research and development. Company A and company C also spend a lot of money on advertising. So they have a product which would probably be more available in the market. Consumers may be more informed about it. And therefore, probably these companies feel that they should spend more on each of these things, that is research and development, advertising, while at the same time reducing their cost of sales. So while cost of sales is a lot for company B, company C and company A are also spending a lot of money, but they are spending it in a different area. They're spending it in research and development, and they are spending it in advertising. And the operating profit margin for both A and B is 20%, which is greater than the operating margin of company B. So now let's see how this can be different from the top portion of this presentation. You can see that it appears just by looking at this that company C has the least amount of operating profit and company B comes number 2 at the operating profit, whereas company A is the top one. However, when you compare them using common size analysis, you find out that both company A and company C are employing similar techniques and probably a similar business model, and both of them have a higher operating profit as compared to company B. Let's now move on to analyzing a balance sheet using common size analysis. Again, this is the balance sheet of 3 hypothetical companies, and you can see that in this slide, just the absolute figures have been noted. Again, we can see that these 3 companies are not comparable because total assets of company A and company B are similar, but company C looks like it is 3 times that of company A and company B. Let's see how this statement can be converted into common size analysis. While converting a balance sheet to a common size, you have to take total assets as the base. That means total assets of any company will be 100%, and every other line item, be it cash and cash equivalents, marketable securities, accounts receivables, inventories, it must be taken as a percentage of total assets. You can simply use an Excel sheet, as I told you on the previous slide, to convert any balance sheet into a common size balance sheet. Let's see how that looks like. Well, this is the common size balance sheet of the 3 companies A, B, and C. You can see that on this slide, these companies look more similar because all the assets are 100% or just 100. So you know that there is a standardization between these 3 companies. Now these companies have become more comparable. Let's have a look. Company A has cash and cash equivalents of approximately 60% of total assets, while company B has just 6% of liquid assets. Company C is somewhere in between. So from these 3, we can say that company A is the most liquid company out of the 3. Next comes company C, and third comes company B. While on the previous slide, it appeared that company A and company B are comparable. They are more similar looking at the total number of assets. On this slide, you can see that actually company A and company C are more similar. They have a similar mix of accounts receivables and inventory. And you can see that company B is holding a lot of account receivables and it is also holding a huge amount of inventory. And it comes to about 62% of total assets. Company C is holding the maximum percentage of property, plant and equipment, which is fixed assets. Let's come down to look at current liabilities. We can see that company A hardly has any current liabilities. If you remember on the previous slide, company A did not have any accounts payables and it had only 10,000 of long-term bonds. Company B has about 2.5 million of just current liabilities, whereas company C is somewhere in the middle. Now let's look at what it is in terms of common size. Company A is mostly funded by shareholders' equity. It has very little debt on it. Company B is primarily funded by debt. 77% of the company is funded by debt and very little of shareholders' equity. Same way, company C is primarily funded by debt. 98.5% is debt, only 1.5% is shareholder equity. Now, what do we summarize from all this information? Well, we can see that company A has a lot of liquid assets, cash and cash equivalents and marketable securities. And even if it had a little more debt on it, it would have nothing to worry about because it has sufficient cash. It is sufficiently liquid. in order to meet any of its near-term or future-term liabilities. However, when we look at company B, we can see that only 6% of it is in liquid state, whereas 77% of debt is on the company. It is possible that this company may not be able to repay its debt when the time comes. It may also face difficulties in servicing the debt, that is, in terms of paying interest to the bondholders. Therefore, in case of a crisis, in case of a crunch, this company will be forced to liquidate its inventory and its receivables. And still, if it is not able to meet all the debt, it may even have to dispose of some of its fixed assets. So this is a very dangerous position for a company to be in. When we look at company C, we can see that its marketable securities and cash equivalents are about 34%, whereas its debt is 98.5%. So while it has sufficient liquid assets to fund any of the servicing requirements of the debt, it may have to think about generating more cash as the debt comes due, whenever the debt has to be payable. So with this, I hope you have got a generic view of how you can compare companies which are not of the same size. You cannot use either of these tools to effectively analyze the cash flow statement. So in the next lecture that I'll take, I will talk about the ratio analysis through which you can analyze income statement, balance sheet, as well as cash flows. Thank you very much. I hope you enjoyed this presentation. If you have any questions, please feel free to reach out to me.